Okay. I want to welcome Clay Malcolm from New Direction IRA. And what we're going to go through today is explaining what a self-directing IRA or individual retirement account is, some of the compliance issues, how to make it work, how to transfer, and what the opportunities within your account that you manage yourself in terms of the investment world. With that, I'd like to turn over to Clay Malcolm and start with the presentation.
Thanks, Ray. I appreciate it. It's good to be here, and I'm always excited to talk to folks about self-directed IRAs and the way that it works in their financial world, and to just kind of give them the option, explain what it is, and show them the opportunities that are available. One of the things I'll just mention is that all the information I'm going to give is for education purposes only. At New Direction IRA, we don't give any tax, legal, or investment advice. We don't advocate any particular asset or asset class. We don't sell assets. And we don't advocate any particular asset vendor. And we certainly encourage you to talk to your financial team or your real estate team anytime that you're considering an investment for your IRA. And most of the time when you have a disclaimer, it's a little bit of a throwaway, just kind of to start a presentation. But this one is actually pretty important because it does talk about the idea that the self-directed IRA provider is not going to be the motive force for the account. And this is really one of the great things about self-directed IRAs is that the account holder is going to choose the investments, do the negotiating, so on and so forth. So you really get to be in control. It's not us. We're really just a service, and our role is to make sure that the IRS is covered so that you get to keep the tax benefits.
I think that's one of the challenges, Malcolm, excuse me, Clay, I apologize for that, is that with a lot of folks looking to transition, like in a traditional account, they're looking for their advisor to tell them which direction to go into. And I think what you just explained there is that you are the manager of your future and your retirement account long term.
That's exactly right. And you get to bring your own expertise and your team's expertise to bear on what you buy.
And that's the opportunity for itself to get better returns you could from, say, a traditional house in some cases.
Right. Well, that's the interesting thing, too, is so, over the last several years, so many people have put their old 401k or their IRA on the sidelines trying to figure out what to do. So it's really shocking how much money is in tax-advantaged accounts that isn't being put to work. So if you've already made the contribution, the important thing now is to get that money to make money.
And I think unlike the last, say, 10 years, and maybe more recent in the last 3 years, the way I look at the investment opportunity long-term, whatever you're investing in, is that there's a lot of folks out there making 15, 20, 25% on their accounts. And if you're making less than that, because right now everything's ripe. The stock market's up, real estate's up, gold is up, and some other types of investment vehicles are all up right now. And I think it might go that way for the next few years. So if you're making less than, say, 15%, 10% of your traditional model, you might want to consider an alternative, and self-directed is probably the best way to go.
Yeah, absolutely. And just so everybody is clear out there, you'll certainly see banks and brokerage houses that will offer self-directed accounts. And really what that means, because self-directed is just a descriptive term, is that the account holder is going to have some sort of choice in terms of the assets that they buy. But at a bank or brokerage house, of course, they will limit your choices to the things that they sell, so usually publicly traded securities. So as an investor, the thing that you're looking to do is put your IRA money with a provider that handles the assets that you want to be into. And of course, you're able to have multiple IRAs and move them around without tax and without penalty. So the match that you're looking for really is having your IRA funds established at a place where it can go out and buy and sell the assets that you want to get into.
Absolutely.
And so adding self-directed onto any of these account types is possible. So the account types don't change. Those individual plans of traditional Roth and the health savings account, the account contribution limits are the same, the rules for distributions are the same, and the tax advantages are the same. The only thing that changes at a provider that handles alternative assets is your ability to have that tax advantaged money buy those assets. And same for the employer plans. So if you're, particularly if you're self-employed and you're a full-time real estate investor, you can have an employer plan like a SEP or an individual 401k where the contribution limits are much higher. But do understand, too, that a lot of these plans, if you've already contributed to them at a past employer or something like that, you can move them into position to purchase all kinds of assets. And, lots of times people are focused on real estate because it's been so positive for the last couple of years. But, the accounts stay the same. It's really just the things that money is going to buy in its tax advantage state that changes. And just to give you a broad scope part of it before we get into too much detail, but the IRS, and a lot of people I think confuse some of the entities in the equation. So from our perspective, we're not going to tell you what to invest in or when to buy and when to sell. And really the IRS isn't either. They're really interested in tracking the money so that the eventual tax event is what they think it should be according to the rules. So they don't really approve investments. So the due diligence part of your IRA investing is in your court. So you're the person who needs to be satisfied that the investment is going to be a good one and hopefully return the investment the returns that you think you're going to get from it or better. But your due diligence is the one that actually is that's the threshold. Now the IRS does have a couple of prohibited asset classes in their life insurance and collectibles. Life insurance is pretty self-explanatory. Collectibles is really anything that derives its value from its collectible nature in the collectible marketplace. That's usually pretty cut and dried as well. Every once in a while you get a little bit of gray area when it comes to something like a semi-numismatic coin or something. But for the most part, if it's fine art or an antique rug or an investment wine cellar, those things are prohibited as asset classes for the IRAs. And when I say IRA, I'm using that as shorthand for all those accounts that we talked about on the screen before.
And Clay, why would that be? Is it terms because of its value, or is it because it's not liquid enough, or it's hard to put a value on something that's a collectible like artwork?
Yeah, I tend to think it's just for the IRS's convenience, because I think that if the IRS's goal or idea is to make sure that the tax event is what they think it should be according to the rules, I think that they think it would be easier to disguise or confuse the value of something like that so that the tax event would be less. And so I think that because those marketplaces are less established, less easy to substantiate, I think they think it makes it easier for the person who wants to maybe pay less taxes to figure out a way to do that. So they just said forget it.
Why deal with it? Makes sense. Okay.
Right, exactly. And so if those are the only two things that are prohibited, there's a lot left. So there's precious metals, that's gold, silver, platinum, and palladium. It's bullion products of a certain fineness. You can do a paper version of that, but you can also actually have your IRA own the physical metals. Any company, publicly traded or not, so private companies are available, and a lot of times these days we're seeing IRAs and invest in an LLC or some sort of other entity like that that's collecting investors, and then they go out and buy some bigger piece of real estate or a portfolio of notes or something like that. So private equity, in other words, investing in a private company, is allowed for IRAs. The broad picture there is really about lending, so your IRA can be a lender. It can originate notes, but it can also buy notes that have already been originated, so perhaps non-performing or something like that. I put the oil rig on there to just show that almost anything you know how to make money at outside your IRA, you can make money at inside your IRA, as long as you take the time to set it up properly. So it could be the oil rig company or the trucks that move the crude to the refinery or the mineral rights to the land. All those things are possible assets for the IRA. And then real estate is a super popular asset, and so I put a couple of examples on there. It doesn't always have to be, let's say, a single-family residential. It could be agricultural land or raw land, storage facilities, all kinds of things like that. So your ability to get into the asset where you have some expertise or that asset is tailored to your financial needs is really pretty great. And I'll just spend a moment here on real estate. And you may have gleaned this from the slide before, but the idea is your IRA as an investor, And do keep in mind that your IRA is its own legal and financial entity, and it's separate from you because it has separate tax properties, right? So, but as a buyer of assets, it can own title, so it can buy the property outright, and that's the name of your IRA, not you personally, because it's your IRA with those tax advantages. If you don't have the full purchase price, you can certainly get a loan. It has to be non-recourse in most cases, but it is available out there, so you can increase your buying power by having your IRA borrow money. And it's actually one of the only ways where your IRA can make money on money that you never had to contribute to the IRA. So it's got some advantages there if you're comfortable with it. You can also be tenants in common with other investors, and that could be other IRAs or people or companies. And then going back to those other two asset classes, lending, and a lot of times those loans have a collateral in real estate, but the lending really can be secured or unsecured by collateral, so there's a lot of latitude there. And then equity in an LLC or other entity, as I mentioned before, sometimes people, for a variety of reasons, will want to have either another corporate entity in there or a land trust or something like that, but all those are available from an IRS perspective.
And let me ask this question on those, when it comes to real estate. If there's an entity out there that has a PPM, a private placement memorandum, and it's real estate centric, so you have different types of, you have a Class C and a B. The Class C, a 506B, needs to have accredited investors. And from my understanding, with the individual retirement account, when it's self-directed, they can invest in a PPM without the classification, from my understanding, of being an accredited investor. Is that correct, or am I misreading that or misheard that?
Well, it's interesting that you bring that up, because that playing field has broadened so much with the Jobs Act that the mechanism that the offerer is using, so whoever it is generating the private placement memorandum, it kind of depends on how they filed with the SEC or with the state where they are. So the thing I'll just say about that is that the IRA, at least at this point, it's industry standard for the IRA to follow the accreditation of the account holder.
Okay.
So if the private placement is only for accredited investors, the only IRAs that can invest in it are IRAs of accredited investors. Now that may change through time, but at the moment that's the industry standard.
That way it keeps it cleaner that way from an investment standpoint, and that way the PPM isn't in jeopardy of bringing in funds to a non-accredited investor, even though the funds are available. At the same time, you can still out there solicit accredited non-IRA holders into that same PPM. Okay.
Right. And, the other thing, too, is that, with Reg CF and Reg A Plus and those kinds of things, sometimes there can be a combination of accredited and non-accredited. So it's really investment specific.
Okay. Thank you. Thanks for the clarification.
Yeah, you bet. And then, one of the things that is, I think, important to realize from a conceptual standpoint when somebody's moving from a publicly traded stocks, bonds, mutual funds IRA to something that's going to buy alternative assets is the mechanism of the IRA. Again, it's its own legal and financial entity. And so if the white part up there is your IRA's tax world and the green part at the bottom is your personal tax world, they're separate. And there's a barrier there, and it really only gets crossed by contributions and distributions. And if you do a traditional to Roth conversion, that's a little bit of a different hybrid there as well. But so money moves from your personal finances to the IRA world via contribution. And if you've made contributions to an account earlier, that can be via rollover or transfer. And the distributions, of course, when you decide to do that, and most people wait till 59.5 because that's when the early withdrawal penalty goes away, you can either take your distributions in cash or in kind. So if your IRA owns physical real estate or notes or things like that, and you want to just distribute the asset and not liquidate it in the IRA, you can. So you have some options there. But one of the things that's happening while that money is in that tax advantage state in there above in the white part of the slide is it's growing, hopefully, from rent, appreciation at sale, buying another property, or as I mentioned, investing in an LLC or notes or things like that, that money that's in the IRA, it could actually make $1 million in a year, and it wouldn't affect your personal taxes at all that year unless you made a contribution, a distribution, or a conversion, right? So that entity is running with its own tax status, and it's hopefully growing, and it can be very dynamic in a year and not affect your personal taxes. So realizing that those two tax worlds are different, you control both of them, of course, but that they are different can sometimes make a difference for your strategy. So do understand that rent and appreciation from sale or loan payments, that's the way your IRA is making money instead of stock dividends or things like that.
So as an example, Clay,
yeah.
if you have a retirement account, self-directed, and they were to invest, say, $50,000 into a piece of property, and they were able to turn that over 3 times in a year, and say, for example, they were to make, most models out there be $15,000 to $20,000 per investment on a piece of real estate. So they would almost make 110% on their initial $50,000. They collected all the profits before end of year. So if I understand correctly, that just rolls over. There's no taxation. There's nothing that is being they're not hurting themselves. They're actually only gaining. So they can make as much money as they can in that given year based on the investments they're investing in.
Right, and it's not getting chipped away at taxes. I think a lot of financial professionals will tell you that the great get of this IRA situation is that, if you buy a property for 50 grand, you sell it for 65, the entire 65 comes back and is able to be reinvested. So that money's ability to compound itself is greatly enhanced by the tax status. So it really is an opportunity to get that money to make more money because it'll compound faster.
Yes. Okay.
Yeah. And going back to our paradigm here of an IRA being its own legal and financial entity, do realize, of course, that the IRA pays for purchase, it pays for maintenance, it pays for insurance, taxes on a property. If the IRA has made a loan and it needs a loan servicer, it can pay for that, or any legal or professional services. The IRS will let IRA holders protect their IRA investment, and so that's absolutely allowed. And the IRA pays for all those things, and it receives all the returns. So it's a little bit of a closed financial system that the IRA account holder is actually operating, making all the strategic choices for. But it is operating to some extent in a separate world than your personal finances.
So with the expenses, Clay.
Yeah.
So say each transaction generates 5% expenses on, say that's $65,000. So you get about $3 grand expenses. In normal, like for myself, if I'm an investor, I would take that as a deduction to my taxes. In this case, you're not paying any because it's going in tax-free. Do you claim those expenses when you get 59.5? You want to start taking out distributions, or at some later time?
You would not. It's actually a different mechanism. Now, not to get into too much of the deep dark waters here, but some IRA investments will incur something called UBIT, unrelated business income tax, and you can make some expense and interest payment kind of deductions on that calculation. But more often than not, because the IRA is already in a tax deferred state, the expenses that you got into to handle the transaction or the asset itself is just part of your bottom line, and you just need to calculate that when you're thinking about what your return is going to be.
Okay, fair enough.
Yeah. And so as I've gone along my theme here of an IRA being its own investor, it does have a different name, and you'll probably recognize this naming convention from any IRA or 401k that you've had. So it's the provider name, in this case New Direction IRA, FBO is for benefit of, and then your name and the account type. I know that from our business practice we'll also allow the account number, and some people use both for added specificity. But do understand that every single piece of paper that's tied to the investment, So whether that's the title work on a piece of property, the operating agreement of an LLC, the promissory note, that's all in the name of the IRA and not you personally. A couple of other little quirks about it, because this money is being held in trust by the custodian, that's why you have to have a custodian, is because the IRS is tracking that money. So it gets reports each year, and it's just kind of following it along. But that means that the IRA administrator is actually the signer for the IRA. So paperwork typically goes to the account holder. They write read and approved and sign it in the margins, and then the actual signer for the IRA, that name that's in the top of the slide there, is one of the signers here at the office. And if you are going to be entering into an investment that requires some money up front, like earnest money, you want to make sure that it always comes either directly from the IRA or from a non-disqualified person. So there are some restrictions for some people in the way that they interact with the IRA's finances, and so it's important to learn that stuff ahead of time. But generally speaking, if you're thinking about the IRA, just make sure that it's the titling is proper on all the documents, and the money for purchase, maintenance, and all that kind of stuff comes from the IRA.
Okay.
And I went ahead and did a case study here just because it's unusual to be a person and be operating kind of several investment vehicles. And so I went ahead and I didn't ask Ray's permission ahead of time, but I probably should have. I used REVitalize here. And really this is just illustrating the idea that these are different pots of money, so to speak, and they all operate in their own tax world. So your personal finances are over there on the left. So you could find an investment on REVitalize for your personal finances. In that same trip, you might also find an investment for your IRA or your 401k. And same with your HSA, which is a little bit different vehicle, but operates very much like an IRA. So they all have their own tax status. They all operate separately, but it's all you. It's all the one person, but you have multiple possibilities if you're aware that those funds can be used for alternative investments.
It's just all leveraging.
I'm sorry?
It's all leveraging.
Yes, yes. And then one of the things that I'll just mention too is that it's relatively easy to move from this publicly traded bank or brokerage house IRA to a world where all kinds of investments open up. So you'd open your account. That gives you a place for the money to go at a provider that can handle these assets. You put some money in that vehicle, so fund the account with a rollover, transfer, and/or contribution, and you can do a combination of those things. So if you have an old 401k and an IRA and you want to condense them and put them all into one account, you can obviously do that. And because it's the account type that you have, whether that's traditional or Roth or any of those things, you can still make contributions if you're eligible to do so. But as the last slide demonstrated, if you know how to source investments, whether that's your financial team or your real estate team, or you go on to REVitalize, or however you do that, that could be a source of the investments for your IRA. So all it really takes is you have to give us permission, of course, to do anything with your IRA money. So when the deal is going to close, you'd need to give us your written permission to send money out of your IRA. And then we would help you assemble the documents that substantiate that that's what your IRA now owns. And so all the returns would come back to it.
Excellent.
Yeah. And so, again, keep in mind you can have multiple IRAs, multiple accounts, and they all function just the way the rules are. So do understand that funding your account can be flexible. And if you have an investment or that you want to make and you already have a self-directed IRA, you can just do an additional transfer. The amount of transfer and rollover is entirely up to the account holder. And I do get a lot of questions about timetables, so I'll just give this to you real quickly. You can open your account. We quote 2 business days, but frankly, you get the account number in 15 minutes if you use the online application. Rollovers and transfers often take 1 to 4 weeks. That's a little bit hard for us to calculate an exact time because it requires the participation of the resigning custodian. And then finding the investment is probably something that you know more about than I do because you have your own specific investment in mind. But we like to have the investment documents in the office 3 business days before your IRA money needs to be sent out to close the deal. So we need a couple days in the beginning, a few days at the end, and the rest is really just making sure that the money arrives and we have the documentation. And we're an ongoing resource for self-directed IRA education, so if you have additional questions, I know that this is kind of an introductory program, so please feel free to give us a call or send us an email or visit our website, and I'm happy to chat with Ray as long as you'd like to. And thanks for listening, everybody.
Clay, thank you very much for providing this information. As you know, education in any venue, whether it's real estate itself by itself, an IRA to become self-managed, is important to put those pieces together and have clarity to the person or thinking of this right now. And I think we both know that at the end, there's couples, there's people looking around saying, what do I do and how do I enhance what I'm already involved in if they already have a self-directed IRA, or to look your time today. I appreciate your direction and information they're providing, and look forward to getting this information out to the public.
Well, I was happy to be with you today, Ray. Thanks.
Thank you.